Ray Dalio built Bridgewater Associates into the largest hedge fund on the planet. $150 billion under management by doing one thing nobody else on Wall Street wanted to do. He studied history, every bubble, every crash, every empire that rose and fell. And right now, he's saying something that most people in Silicon Valley and on Wall Street do not want to hear. The AI bubble will burst. And what happens after will.
I want to start with something that might make you uncomfortable. Everything that is happening right now, the AI euphoria, the soaring valuations, the absolute certainty among investors that this technology will change everything and that prices can only go higher. I have seen all of it before. Not something like it, not a rough approximation, the exact same psychological pattern, wearing different clothes in a different decade with different company names on the ticker. I have spent over 50 years studying economic history, not as an academic exercise, as a survival mechanism. When I was 12 years old, I bought shares in Northeast Airlines with money I earned caddying at a golf course in Long Island. The stock tripled. I thought investing was easy. A few years later, I was humbled in ways I will never forget. And that humbling, that collision between what I thought I understood and what the market actually was, launched a lifelong obsession with understanding how things really work, rather than how they appear to work. That obsession eventually became Bridgewater Associates, which I founded in 1975 out of my two-bedroom apartment in New York City. We grew to manage more than $150 billion, but the thing I am most proud of is not the money. It is the system of thinking we built to understand the world, what I call the economic machine, and the template it provides for reading what is happening right now with artificial intelligence. Let me tell you what the template says. Every great technological revolution in history has followed the same basic arc. A genuine breakthrough emerges. The breakthrough is real. The technology works. The potential is enormous. Early investors who recognized it early make extraordinary returns. That success attracts more investors. More capital flows in. Valuations rise beyond what the underlying earnings can justify. The gap between price and reality widens. Excitement replaces analysis. Fear of missing out replaces discipline. And then, at some point, not because the technology was fake, but because the prices became disconnected from reality, the bubble bursts. This happened with railroads in the 1840s. It happened with electricity in the 1890s. It happened with radio in the 1920s. It happened with the internet in the late 1990s. Every single time, the underlying technology was transformational. And every single time, the majority of investors who bought at peak valuations lost enormous amounts of money, even though they were right about the technology. Being right about the technology is not the same as being right about the investment. I want you to sit with that sentence for a moment because it is the thing that most AI investors are not sitting with right now. The AI bubble, what the template is telling us. In 2023 and 2024, artificial intelligence became the most exciting investment narrative on Earth. NVIDIA's market capitalization grew from roughly $300 billion to over $3 trillion in less than 2 years. AI exposed companies grew by trillions of dollars. Capital flooded into AI startups at a pace that made the dot-com era look measured by comparison. I am not here to tell you artificial intelligence is not a transformational technology. It is. The breakthroughs in large language models, in generative AI, in the application of machine learning across every sector of the economy, these are real. This technology will change the world in ways that will take decades to fully understand. But I have lived through enough cycles to recognize what is happening in the psychology of markets right now. And what I see is not rational exuberance. It is the specific flavor of irrationality that always precedes a painful correction. When I look at the valuations of the leading AI companies today, I see companies priced not for what they are earning now or what they will reasonably earn in the next 5 years, but for the most optimistic possible scenario, playing out perfectly with no competition, no regulatory interference, no technological dead ends, and no macroeconomic headwinds. That is not an investment thesis. That is a wish list. And here is what history teaches us about wish lists. The market charges you full price for them up front and delivers them, if at all, decades later. But the AI bubble does not exist in isolation. And this is where I want to go deeper than most analysts are willing to go, because understanding what is underneath the bubble is more important than understanding the bubble itself. We are currently in the late stages of a long-term debt cycle. I have studied debt cycles going back hundreds of years across dozens of countries, and the patterns are extraordinarily consistent. Nations accumulate debt during periods of prosperity. The debt fuels growth, which encourages more debt. Eventually, the debt load becomes so large that servicing it consumes an ever-increasing share of the economy's productive output. At that point, the central bank faces an impossible choice: raise interest rates to control inflation and risk triggering a debt crisis, or lower rates to stimulate growth and risk inflating asset bubbles to dangerous levels. The United States national debt today exceeds $34 trillion. The federal government is spending roughly $1 trillion per year just on interest payments. That is not principal. That is not investment. That is the cost of carrying the existing debt, and it is growing. This is the environment in which the AI bubble has been inflated. And it matters because when the bubble bursts, and I am saying when, not if, because the template is that clear, it will not burst into a healthy economy with room to absorb the shock. It will burst into an economy already carrying an enormous debt load, with a Federal Reserve that has limited room to maneuver, and a government that is structurally spending far more than it collects. The last time we saw this combination, an asset bubble bursting into a debt-stressed economy, was Japan in 1990. The Nikkei stock index peaked in December 1989 and then fell 80% over the following decade. The Japanese economy entered what became known as the lost decade, a period of stagnation and deflation that actually lasted closer to 30 years. The technology that drove the 1980s Japanese boom was real. The economic miracle was real. The debt and the overvaluation were also real. And when they collided, the damage was generational. I am not predicting that America faces a Japanese-style lost decade. I am saying that when people dismiss the AI bubble by pointing to the genuine power of the technology, they are making the same mistake that every generation of bubble participants has made. The technology being real does not protect you from prices being wrong. People always want to know when. I am going to disappoint you on that question because nobody, not me, not anyone, can tell you the precise timing of when a bubble bursts. What I can tell you is what the burst will look like when it comes, based on every historical precedent I have studied. It will not announce itself. It will not arrive with a clear headline or an obvious trigger that everyone can point to in advance. It will begin with something small: a disappointing earnings report from a major AI company, a regulatory announcement, a macroeconomic data point that shifts sentiment. And in the first days, most people will dismiss it. They will call it a healthy pullback. They will say it is a buying opportunity. The true believers will double down, and then the losses will start to compound. And the companies that raised billions of dollars on AI promises and have not yet found a path to profitability will start running out of runway. And the enterprise customers who signed AI contracts expecting productivity gains will start asking uncomfortable questions about return on investment, and the narrative will begin to crack. This is the moment I have been thinking about, not the peak, but the crack. Because the crack is when the real decisions get made. The crack is when the prepared investor acts and the unprepared investor panics. I remember 2008 clearly. Bridgewater had been warning for years that the mortgage market was building toward a crisis. We had modeled the debt dynamics, we understood what was happening with subprime lending, and our analysis told us that the system was far more fragile than the market believed. Most people thought we were wrong. Right up until September of 2008, when Lehman Brothers collapsed and the financial system froze. In 2007, before the crisis, I wrote an internal memo at Bridgewater that we called the D process, our template for how deleveragings unfold. We described in detail what would happen when the housing bubble burst and how the Federal Reserve would respond and what the knock-on effects would be through the economy. 2 years later, almost everything in that memo had played out. I am not saying this to impress you. I am saying it because the template works. History rhymes with extraordinary precision if you are willing to study it without the emotional filters that make us see what we want to see rather than what is actually there. What happens after the part nobody is talking about. Here is what I think is the most important and least discussed aspect of the coming AI correction. What happens after the bubble bursts is not the end of the story. It is, in many ways, the beginning of the most important chapter. Every great technological bubble in history was followed by a period of brutal rationalization and then by the actual, sustainable, world-changing deployment of the technology that the bubble was about. The railroads that went bankrupt in the 1840s became the backbone of American commerce for a century. The internet companies that collapsed in 2001 laid the fiber optic infrastructure that made Amazon, Google, and Facebook possible. The winners that emerged from the wreckage of every bubble were not the companies that raised the most money during the mania. They were the companies with the strongest fundamentals, the most defensible competitive positions, and the balance sheets to survive when the capital dried up. This is what I am watching for, not the peak of the AI bubble, the aftermath, because the aftermath is where the real fortunes of the next generation will be built by investors who had the patience to wait for rational valuations, the knowledge to identify the genuinely transformational survivors from the rubble, and the capital to act decisively when everyone else was still too traumatized by the losses to think clearly. People ask me what they should do. They want a simple answer: buy this, sell that, move here, move there. I understand the appeal of simple answers, but simple answers in complex environments get people hurt. What I can share is the framework I have built my entire investment philosophy around. I call it all weather, an approach to portfolio construction designed not to maximize returns in any single environment, but to perform reasonably well across all environments. Rising growth, falling growth, rising inflation, falling inflation, all four quadrants of the economic machine. The reason I built all weather was precisely because of moments like this one, moments when the environment is shifting in ways that most investors are not yet recognizing. The AI bubble environment has rewarded concentrated bets in high growth technology stocks. The post bubble environment will reward something very different: diversification across asset classes that respond differently to economic conditions is not a glamorous strategy. It does not make headlines. It does not generate the kind of returns that go viral on social media during a bull market, but it is the strategy that keeps you in the game through the corrections that end most investors' best years. Right now, I am thinking about several things simultaneously. I am thinking about the dollar, the long-term trend of dollar weakness that I believe will persist as America manages its debt load through a combination of financial repression and currency devaluation. I am thinking about gold, which I have increasingly come to view not as a relic, but as the asset that thrives when faith in paper currencies erodes. I am thinking about emerging markets, particularly in Asia, where debt levels are more manageable and demographic tailwinds are more favorable. And I am thinking about the genuine survivors of the AI space, the companies with real revenue, real moats, real competitive advantages that will be worth dramatically more in 20 years than they are today, and that the bubble burst will eventually offer at dramatically more rational prices. I built Bridgewater on a principle I call radical transparency, not just transparency with others, but radical honesty with myself about what I know and what I do not know, about where my models are right and where they might be wrong, about the difference between the world as I see it and the world as it actually is. The hardest application of that principle right now is looking at a technology I genuinely believe in. Artificial intelligence is going to reshape the global economy in ways we cannot fully predict, and simultaneously acknowledging that the prices being paid for that technology are disconnected from any rational valuation framework. Both things are true. The technology is transformational, the prices are dangerous, and the ability to hold both of those truths in your mind at the same time without collapsing into either denial or panic is the most valuable cognitive skill an investor can develop. The biggest mistake investors make is to believe that what happened in the recent past is likely to persist. What happened in the recent past is that AI stocks went up a great deal. A great deal of money was made by people who concentrated their portfolios in the most exposed companies. That past will not persist. It never does. The template is too consistent, the human psychology too predictable, the mathematics of valuation too immutable. What will persist is the underlying technology, and the investors who position themselves to survive the correction and capture the genuine long-term value of that technology rather than the speculative froth built around it will look very smart in 10 years. Infamble will burst. I do not know when. The template does not come with a calendar. But when it does, when the crack appears and the losses start to compound and the narrative starts to break, the question will not be whether you saw it coming. The question will be whether you prepared. Preparation is the only honest answer to uncertainty, not prediction, not timing. Preparation, diversification, capital preservation through the correction, patience to act when rational prices return. That is what the template teaches. That is what 50 years of studying economic history has shown me. And that is what I am doing with my own capital right now, while most of the people around me are still talking about how high AI stocks can go. The machine always wins eventually. Your job is to understand the machine well enough to still be standing when it does.
Ray Dalio has called more major economic turning points than almost any investor alive. And right now, he is saying the same thing he said before the 2008 crash, before the dot-com collapse, before every bubble he has ever studied. The template is playing out. The only question is whether you are prepared for what comes after. Your action this week: review your portfolio and ask yourself honestly, if AI stocks drop 50% tomorrow, would you survive it or would it change your life? That answer tells you everything you need to know about what to do next. Are we on the verge of the AI bubble bursting? Let me know what you think in the comments below, and I will see you in the next one.